Hey there. Ready to unlock the secrets of savvy real estate investing?
Absolutely.
Today's deep dive is all about analyzing deals like a pro, especially when it comes to rental properties, which I know you're interested in.
Yes.
We've got this awesome guide that's packed with insights, so let's jump right in.
Let's turn you into a real estate whiz. The first step in analyzing any deal, whether you're flipping or renting, is understanding the market you're stepping into.
Okay, so it's more than just browsing listings online. What kind of detective work are we talking about?
Think of it like this. You wouldn't invest in a company without looking at its stock performance.
Right.
Right. Real estate is similar. We need to examine price trends. Are they going up or down? What about vacancy rates? A bunch of empty units could signal weak demand. And that's not good news for your rental property goals.
Right, makes sense. Lots of vacancies, not a lot of rental income.
Exactly. And zooming out even further, we need to consider the bigger economic picture. Employment rates, population growth. These are indicators of a healthy market that can drive housing demand. A thriving job market usually means more people needing places to live. Imagine trying to rent out a property in a town where everyone's moving away. Not ideal.
Gotcha. So it's about finding those sweet spots with a good economic pulse. Makes sense. But what about the neighborhood itself? Is that part of the equation too?
Absolutely. The neighborhood can make or break a deal. Think about it. Safety, schools, parks, shops, restaurants. These all impact a renter's quality of life, which translates to your property's desirability. A great property in a less desirable area might be harder to fill, or you might not be able to charge top dollar for rent.
Wow, I hadn't even considered that. So it's like finding the Goldilocks zone of real estate. Good market, good neighborhood, and of course a good deal on the actual property. Speaking of deals, how do we crunch the numbers to make sure an investment is worthwhile?
That's where the real fun begins. Let's dive into the financial deep dive. Starting with a term you'll hear a lot in real estate, cash flow. This is the lifeblood of your investment, the money you actually get to pocket each month after covering all the costs.
Okay, so it's like my take-home pay, but for my rental property. How do we figure that out?
It's all about simple math, really. You take your gross rental income, subtract your operating expenses, things like property taxes, insurance, maintenance, and then factor in your mortgage payments. What's left over is your cash flow. Positive cash flow means you're in the green. Negative means you're dipping into your own pocket each month. Not ideal.
Definitely don't want to be in the red. So once we have a sense of potential cash flow, what other metrics should we be looking at? I've heard the term cap rate thrown around a lot. What's that all about?
Great question. The capitalization rate, or cap rate for short, is a way to compare different investment opportunities, like weighing the pros and cons of two different rental properties. It tells you what kind of return you can expect on your investment based on the net income the property generates. Think of it like comparing interest rates on savings accounts. You want the best bang for your buck, right?
Right. The higher the return, the better. So a higher cap rate is always a good thing.
Not necessarily. While a higher cap rate might seem enticing, it's essential to remember that it often comes with higher risk. For instance, a property in an up-and-coming area might have a higher cap rate because it's considered riskier. On the other hand, a property in a well-established low-risk area might have a lower cap rate, but offer more stable returns. It's a trade-off to consider based on your risk tolerance.
That's a great point. It's like that old saying, high risk, high reward. But sometimes slow and steady wins the race, especially in real estate. So we've got cash flow and cap rate. Any other financial formulas I need to add to my real estate toolkit?
You bet. Let's talk about cash-on-cash return. This one tells you how much money you're making specifically on the cash you invested, rather than the total property value. It's like comparing a traditional savings account to investing in a rental property. You want to see which one gives you the better return on your actual dollars. Then there's the break-even ratio, which is all about managing risk. It tells you how vulnerable your investment is to things like unexpected vacancies. Think of it as a financial safety net for your property.
Okay, that makes sense. I like the idea of a safety net, especially with a big investment like real estate. But you know all these formulas. Can we ground them in some real-world examples? I'm a numbers person, and seeing those calculations in action would be super helpful.
Absolutely. Let's bring those formulas to life. Say you find a property that costs $250,000. It brings in $2,500 per month in rent. But you've got monthly expenses, like property taxes, insurance, and maybe a little set aside for maintenance. Let's call that $1,800. That leaves you with cash flow of $700 each month. Now, to get your cap rate, we'll say the net operating income. That's your income after expenses but before the mortgage. Is $10,000 annually. Divide that with the purchase price, $250,000, and multiply by 100. That gives you a 4% cap rate.
4%. Got it. Now, is that a good cap rate? A bad cap rate? What am I aiming for here?
Well, like we talked about earlier, cap rates depend a lot on location and property type. A 4% cap rate in a stable, slow-growth area might be considered pretty decent. In a hotter market with more appreciation potential, you might set your sights a little higher. Remember, it's a balancing act between risk and potential reward.
Makes sense. It's not a one-size-fits-all situation. Got to consider the bigger picture. Okay, so we got our potential cash flow. We've looked at the cap rate. What about cash-on-cash return and the break-even ratio? Got any examples for those?
Let's say you put down 20% on that $250,000 property, which comes out to $50,000. And your annual cash flow, like we figured out, is $8,400, $700 a month times 12 months. Your cash-on-cash return would be a tidy 16.8%. As for the break-even ratio, if your total expenses includes that mortgage payment, come to around $21,600 annually, and your gross income from rent is $30,000. Your break-even ratio is 72%. Remember, the lower that break-even ratio, the better. It means you're less vulnerable to things like those pesky vacancies we talked about.
Got it. It's all starting to click now. This is so much more insightful than just browsing those online listing sites. Speaking of which, you mentioned comparing properties earlier. Is that where something called a CMA comes in?
You got it. A comparative market analysis, or CMA, is like doing your due diligence when you're shopping for anything important. Think of it like this. You wouldn't buy a car without checking prices from different dealerships, would you?
Definitely not. Got to make sure I'm getting the best deal. And not overpaying just because I walked into the wrong dealership.
Exactly. It's about being an informed consumer. In real estate, we use comps. Those are recently sold properties that are similar in size, features, and location to the one you're considering. They give you a reality check on pricing.
So it's like checking the price history on the online auction site everyone uses, making sure I'm not getting ripped off, right?
You nailed it. And don't just fixate on the overall price tag. Pay close attention to price per square foot. It gives you a much more accurate way to compare properties, even if their sizes differ. For example, a massive house might seem expensive at first glance, but it could be a bargain per square foot compared to a tiny condo in the same neighborhood.
That's a great point. I'm all about finding those hidden value opportunities. But let's be honest, a property can look fantastic online. But what about those hidden issues that might not be obvious in photos? How do I avoid those deal-breaker surprises?
That's where professional inspections become your best friend. Never, and I mean never, skip a professional inspection. They can uncover potential problems. Think foundation issues, plumbing nightmares, hidden mold. That can cost you a fortune down the road if you're not careful.
Yikes, that's scary. So it's like a medical checkup for a house. I'd rather know about a pre-existing condition up front than be stuck with a huge medical bill later. Or in this case, a massive repair bill. So we've got the market analysis, the financial tools, and the importance of inspections. What about actually finding these potentially lucrative real estate deals?
Okay, ready to roll up your sleeves and hunt down some deals. Let's start with outlining your investment criteria. Are we talking a hands-on project like a fixer-upper you plan to flip? Or something more passive like a rental property? And since you mentioned being interested in rental properties earlier, are you thinking short-term rentals? Or something more long-term?
Yeah, I'm leaning towards a more hands-off approach, at least for now. And long-term rentals sound pretty appealing. Steady income, less turnover. I'm definitely open to exploring different areas, but maybe somewhere I have a bit of familiarity with.
Smart move. Familiarity can be a huge advantage in real estate. It allows you to better assess the local market